What a treat to have you, David. Great to see you again.
Great to be on, Carl. Thanks for inviting me.
Your general framework has long been no turn in equities until there's a turn in yields, and I don't know whether or not you think that's even on the horizon right now.
Well, it's on the horizon. It's probably further out than I would have thought even a few weeks ago, a few months ago. You know, interest rates, after all, are cyclical, and we'll just have to wait for the Fed signal. But you're 100% right. There's not been an instant in history where a fundamental bear market in equities ended with the Fed tightening into an inverted yield curve. So we'll have to wait for the fateful day until they not just pause and pivot, but ease policy enough to push the yield curve into a more normal positive slope. Hopefully that'll be the story of the second half of next year. But there's no bottom in the major averages until that happens.
Right. We like to talk about tech on this show. We just had a long discussion about PCs there, but you could add in apparel and autos and freight and commodities. How much do margins need to compress before we do see relief on CPI?
Well, I think that process is already starting, and of course, it first began in the retail sector, and it's going to broaden out. You know, it's very interesting that the corporate sector, last year managed to lump in 6 years of price increases into one. And we went into this year. Remember that the S&P 500 was peaking really heading into the opening days of 2022, just as margins were hitting really their all-time highs. And I think that process has played out. And, you see it, for example, in the latest Fed beige books, that really what started to happen that I think should give the Fed some comfort, but they're not stating that publicly, is that consumers are now starting to push back against these price increases. And so that means that margins will come under pressure. On the other side, look, the good news today in the payroll report was that, 0.3% increase in wages, second month in a row. They're still running hot year over year, but the trend is starting to moderate. That should give some cushion to margins as they come under pressure from weakening demand. And of course, look, commodity prices basically have collapsed. I mean, energy has picked up in the past week because of the OPEC production cut pledge, but commodity prices have plunged, freight rates have plunged, and so margins will come in. I don't think they're going to collapse, but the big problem is going to be not so much from the cost side, but from the top line, from weakening demand in the next several quarters.